Good morning, everybody, and welcome to my weekly market update where I come to you live with what the heck is going on with the market and what new things do you need to know. So three major topics I'm going to cover today. The first one, what's going on with rates? Number two that I'm going to cover is there's actually growing inventory, more houses staying on the market. Is that a good thing or a bad thing? And the third major topic I'm going to cover today is what do you do if your lender denied you for your mortgage? What options do you have? Should you try again? I'm going to cover all of that and give you really good information over the next couple of minutes. So let's go ahead and dive right in. What is going on with interest rates right now? It's been a rocky road. You've heard me continue to say higher for longer. We're going to be here in this range of high sixes to low sevens. Early this week, Monday was a holiday. Tuesday and Wednesday, we saw interest rates spike up. We saw them come down a little bit yesterday, and they came down even more this morning, kind of back in the range of where they were last week. Look, that's just what we're going to see. And we're going to see volatility from day to day. We're going to see numbers bump up and bump back down, and it's hard to track it, or not track it. It's hard to time it. It's impossible to time it. And so you really have to make a decision. Hey, today is the day that I'm in contract for a home. Today is the day I want to move forward on refinancing, and you really should just lock the rates, because the movement is too volatile for us to predict what's going to happen from one day to the next. The bad news is once you're locked, you're locked. The good news is once you're locked, you're locked. So you don't have to worry about it going up. You don't get the benefit of it going down. So just be aware rates are super, super volatile and continue to be that way. I expect them to continue to be that way. Next Friday is the first big report, which is the jobs report that comes the first Friday in June that talks about how many jobs were created in May. We saw the May report being the first time that the jobs numbers started trending down, and that was a good sign for interest rates. Hopefully the report that comes out in June will kind of see the same thing. What is going on with inventory? If you're paying attention, if you're reading the markets, inventory levels, the number of homes listed for sale is increasing. Why is that? Because interest rates are going up. And as interest rates have been high and buyers have been kind of sitting on the sidelines, sellers are bringing more houses to the market that are sitting a little bit longer, okay? In a way, that's a good thing long-term for the market. Short-term, if you are a seller right now and you are looking to, hey, I got to sell my house right now. If you're in California, I'll tell you, you got a bump coming. You've got a big supply, a big amount of demand coming in when the Dream for All vouchers are released sometime in June. We think it's going to be mid to late June. That's going to bring buyers that have to buy within 90 days. And a lot of them are going to want to get in contract right away. So this bump in inventory that we're seeing nationwide is because demand is kind of pulling back a little bit. That means we're not going to see as many price increases. We may see more price decreases. We're definitely going to see more sellers willing to negotiate on the price of the home. And so just be aware of that fact. And if you're a seller, be aware that's kind of the market we're in right now. Normally, summer slows down a little bit. We see a big run up in the spring. We saw that this year, a lot of demand coming up. But in the summer, people start having graduations this month. They start having, you got Mother's Day and then Father's Day and weddings and all that stuff. And everybody says, you know what? I'm going to wait until we get to the end of summer and the kids are getting ready to go back to school before I really start looking again to buy a home. So that decreases a little bit of demand, but the sellers are still coming online. And so that's a good thing for making it a more healthy market because we've had a big imbalance in the marketplace. All right, final topic for today. What do you do if your lender denies you for a mortgage? First of all, it's frustrating. It's sad. It's, you've got your heart set on this home. You wrote the offer because you can picture yourself living there. And now your lender says, nope, you can't have it. You can't move forward with it. And the thing I want to say to you, first of all, is often there is another solution. It might cost you more. It might require a bigger down payment. It might require adding a cosigner, but often there is another solution. And I want to tell you, if you really want the home, don't give up hope. The problem is some lenders only have one tool in their tool belt. They have a hammer. They say, hey, I do a conventional 30-year fix through Fannie Mae, and that's all I do, or an FHA loan. And when all you have is a hammer, everything looks like a nail. And so you've got to make sure that you've got a lender, whether it be the lender you started with, or you need to make a switch to a lender who understands how to use the other tools in the mortgage tool belt. So I want to talk to you about that a little bit this morning and share with you some ideas on ways that you can overcome some issues. So the first issue that comes up is income issues. Income issues, meaning your debt to income ratio is too high. That could be because of your level of income, or it could be because of your level of debt. But the fact is, to solve that problem, you either lower your amount of debt or you increase your amount of income. Now, John, how do I just increase my amount of income? Well, it depends. It depends on what your nature of your income is. For a big group of people that have income issues, it's because they're self-employed and they believe and they know their income is at this level, but the mortgage company looks at what you show on your taxes, and most people are smart enough to not want to pay a bunch of money in taxes, and so they report a lower amount of income. I'll tell you, there's a great opportunity by utilizing bank statements to prove your income. So we simply look at the last 12 months of your business bank account to see how much money is flowing through the account. We take a percentage of that and we treat that as your profit. Bam, you're approved based on those numbers. Now it's a little bit higher interest rate. Instead of being at 7.1, you might be at 7.9. But you also didn't have to revise your taxes to show a higher amount of profit, because now you got to pay that higher amount of taxes to the IRS. Bank statement program for self-employed people gives you the option to avoid doing that. Another challenge is people buying investment properties. If they say, well, I'm buying or I'm refinancing this investment property, but I don't qualify because of my other bills, because of my other debts. Well, there's a program that treats your income only on what you earn from that rental property compared to what you spend on that rental property. So if you own a rental property and you wanted to pull cash out of that to fix it up or to buy another rental or to pay off some debt, but you couldn't qualify because the bank said, hey, we looked at all of your bills and we said, hey, you owe, your business income isn't that good, or your W-2 income isn't that good compared to how much you show on your taxes for the rental income and the expenses you've had on your rental property. This program simply says we're going to ignore everything else. We're going to carve out a box around it, and we're going to simply focus on what do you receive in income on that rental property compared to what you spend on that rental property. It simplifies the approval process. Okay, a rental property is essentially a miniature business, and this is a business loan. We can do it on up to 10 unit properties. So you could own or buy a 10 unit property, and we can simply carve it out and say how much rent is coming in on that property compared to what is the mortgage payment on that property. And that's all we care about is the ratio or relationship between those two numbers. So if you have those situations, those are a couple of solutions. The other solution is a cosigner. So if you said, John, then none of that applies to me. I'm just buying a house. It's my first home, and I'm being told my income isn't good enough. I had a client recently who was in the union, and he's an apprentice, and his income is going up, but he just got a better job in the union, and he's making a lot more money right now. But because his income varies, we have to go back to a 2-year history of what he's earned, which his 2-year history is very, very low. And so what is he going to do? We added a cosigner. We're adding his parents to the loan. We get to basically combine all of his income, all of his parents' income, and compare that to adding up together all of his debt and his parents' debt, including their house payment. And as long as the total amount of income is enough to cover the total amount of payments for everybody, then you qualify. Just remember, adding a cosigner does not typically help with credit issues, but sometimes it does. Sometimes it does. So most people are going to tell you that a cosigner does not solve a problem if you have a low credit score. But there's a loophole. The loophole is on a conventional loan, I get to use the average credit score between whoever has the buyer says, hey, I got a 580 credit score. I can't qualify for a conventional loan, even though I have a huge down payment. And the bank said no, because I don't have good enough credit. But if you have a cosigner you have a 580 and that cosigner has a 780, then I treat your loan as if you had a 680 credit score for the purpose of loan approval. So it helps you to qualify even with a lower credit score, because in this one situation on a conventional loan with a decent down payment, I can use the average of the two people that are on the loan application. And so that in that case, a cosigner can help you when your bank says no because you have too low of credit. There's also another group of loan programs called non-qualified mortgages. These are private loans. Again, you might be 1 to 1.5% higher in interest rates, and you typically need at least 10% as a down payment. So the terms are a little bit more strict. But on those programs, if you have 2 people on a loan, I count the credit score of the person who makes the most money. So I had a client recently who was buying a house with his grandmother. And his credit score was 620. Grandma's credit score is 820, but he makes more money than grandma. So we're using this program, but it didn't help because he made more money than what grandma brings in. But grandma has money in the bank that we can use what's called asset depletion. All that really means is we're saying, hey, if grandma pulled a portion of that money out every single month, how much of that could she use towards her mortgage payment? She doesn't have to use it, but how much could she use? By using asset depletion, I made grandma's income higher than the grandson's income. And now they qualify for the mortgage because I'm using grandma's credit score because grandma makes more money. And on this particular non-QM loan program, we're able to qualify the person who has the highest income using their credit score versus most conventional loans, FHA loans, VA loans, we're using the credit score of the worst scoring person on the loan. So when somebody tells you, hey, your credit's not good enough, or one person on the loan has low credit, and that's the person that if you get rid of their income, you no longer qualify. Well, maybe there's a way that we can make it work with one of these other programs. So don't let your lender say, no, you don't qualify for a mortgage, and then not have looked at other scenarios. Just remember, everything comes at a little bit of a cost. Okay, you're typically going to pay for risk. And if we're taking a higher risk, you might have a little bit higher interest rate or a little bit higher fee or a little bit higher required down payment, but at least you have a solution. All right, asset issues. I get people all the time that say, John, my bank denied me because I don't have money in the bank. I'm not using my own money for my down payment, or I haven't seasoned the money for a down payment, or I don't have enough money left over in the bank to pay for down payment and closing costs and still have a little bit of a rainy day fund. And my bank said no. And really that comes down to how to structure the loan and understanding that through some loan programs, we don't need reserves. Other loan programs let you get a gift for reserves. And people say, yeah, but I don't know anybody who has that money in the bank. There's programs where I don't have to prove the donor has money in the bank. So somebody can give you a gift, even if they just got the money. I don't know any better. And I've got lots of programs that can do that. And so if you're in a situation where somebody denied you and said, John, I can't do a loan because they said I don't have enough money in the bank, or I haven't had it in there long enough, I have a lot of ways that I can help you overcome that. And so don't let that stand in your way. The final thing that gets in people's way is property issues. Now, sometimes it's the condition of the property. Well, I've got renovation loans that can help finance the cost of fixing the property, and you can buy the house in its current condition, even if it's half burned down. Sometimes the condition issue is something small that says, well, hey, I'm doing a VA loan and the seller won't do the pest work on the property. I've got ways that you can do the pest work after or do repairs within the first 2 weeks after you become the homeowner, and you can still take ownership in its current condition. Sometimes it has to do with the fact that the property is a condominium, and the condominium doesn't meet the guidelines of the federal lending rules that are put out by Fannie Mae and Freddie Mac, or FHA and VA. That's pretty common that happens, as a matter of fact. Condominiums are getting harder and harder to qualify for mortgages. You can thank Florida and a lot of the condos that have had problems out there with deferred maintenance. A few years ago, we had the condo complex that literally collapsed, and it's made the mortgage world tighten up, get really, really nervous about condominiums and buying condominiums. And so when you buy a condo, your cash, your credit, your income may be perfect. But if the condominium's financial health is not up to snuff, then you can't do a conventional loan or FHA or VA loan on that condominium. So now what do? I have programs that allow you to buy a condominium, even if it doesn't meet Fannie Mae or Freddie Mac's guidelines. You're looking at a little bit bigger down payment, typically at least 10 or 15% down. You're looking at a little bit higher interest rate, typically something in, maybe 1 to 1.5% higher in rates than what you otherwise would have gotten through a traditional loan. But it allows you to buy the condominium that is likely a lot less expensive than a similar single family home. And as a matter of fact, a lot of these condos actually represent a great opportunity for somebody to purchase a home because you have a lot less competition. Right now, it's really, really hard to find a good home because of all the competition that's out there from all the buyers trying to buy. And these condominiums, condominiums in general represent a less expensive price point to get into a home. So it helps people buy a home without needing as much money out of pocket and specifically not having as big of a monthly payment. Yet, ultimately, you've still got a lot of competition for that condo. But if the condo does not meet Fannie Mae's guidelines, it's now considered a non-warrantable condo. That's the industry term. And if you are shopping for one of those homes, you're going to see that they only accept cash buyers. But you can actually buy using a loan with as little as 10 or 15% down through one of these alternative programs. And now you're not competing. And as a matter of fact, you're getting a lower price because the seller had to lower the price because they had a much smaller pool of buyers that are able to buy that property. So there's lots of ways in which we can help you if your lender says no. So I just want you to know that I'm here if you have questions. Whether you have a question right now, and feel free, if I got about a dozen people watching live, if you watch after the fact and you just have a question, post it in the chat of whatever platform you're watching on, or email us. I am for sure interviewing for the job to be your lender. If you started with another lender, they told you no, but anything I've told you today says, maybe John's got an option for me. Check out this QR code right here, download my mobile app, connect with us, and let me guide you through the process. So I really, really appreciate y'all listening to me today. I hope you have an absolutely wonderful weekend. Try and stay cool as we kick off summer, and we'll talk to y'all soon. Bye-bye.